Hello, and welcome to Agents of Impact, a podcast from Impact Alpha. I'm David Bank, editor and CEO of Impact Alpha. This is another in our series of conversations with agents of impact across the landscape of impact investing, sustainable finance, venture capital, private equity, and of course, founders and entrepreneurs. Today, we're sharing my conversation with Lafayette Square's Damien Dwin. Damien founded Lafayette Square in 2020 as an impact-driven lender to middle-market companies, primarily serving low and moderate income people and communities. They work with their portfolio companies to improve working conditions and well-being, and even cut the interest rate for companies that deploy their Worker Solutions toolkit. Before we hear from Damien, I want to remind our listeners that you can see all of the shows on the Impact Alpha podcasting network at impactalpha.com. While you're there, make sure to sign up for our free weekly newsletter, Impact Alpha Open, or go all in and subscribe to Impact Alpha to get our daily brief in your inbox each morning and many other cool features. Okay, let's get to my conversation with Damien Dwin. Damien, welcome to the podcast.
Thank you so much. Great to be here.
I've been so excited to speak with you, Damien. I've been tracking you and Lafayette Square for many years, and it's super exciting what you're up to. Maybe just start by telling us what Lafayette Square is and how you came to start it.
Of course, Lafayette Square is an investment management firm focused on driving capital to working class places and businesses that employ working class people. We have 55 employees spread around the country, focused on our 2030 goals to create 100,000 working class jobs, invest 50% of our capital in working class places, and finally see that half of our portfolio companies adopt managerial assistance. We are expert investors in the middle market. So our sweet spot is businesses with cash flow less than $50 million, generating EBITDA in industries as varied as tech telecom, healthcare, franchising, business services, and transportation and logistics.
I know you worked many years at Credit Suisse and Goldman Sachs. Is it an obvious question to say that was not the focus of the business at those kind of places?
It's an interesting question. I think leveraged finance and capitalism in general has overlooked geography, which, when you step back and just think about it holistically, is a very powerful determining factor of success for commercial enterprise. Place matters. And so you're right. The places where I trained did not emphasize geography. And that is core to my work here at Lafayette Square, along with centering working class employees. We know that labor and geography are two critically overlooked areas in our current system.
And it's one person's overlooked area is another person's opportunity. So just tell us a little bit about how you see the demand for credit and the credit business in those sectors.
Yeah, as you say, the data reveals most investments today in our private credit ecosystem go to high-income zip codes. Most investors are shocked to learn that 50% of private credit goes to just 5 states: California, Texas, Florida, New York, and Illinois. And 80% of credit flows to high-income zip codes. So exactly to your point, we have identified an attractive investment opportunity nationally. We think it's a more balanced, geographically diverse approach to investing, where we center working class places and businesses that employ working class people because we can get paid and see really interesting job creation and economic mobility opportunities by making credit available in those places and in that way.
And just pause for a second and explain the shift towards private credit, which has become a much bigger deal in recent years. And I think it's partly because the banks have abandoned certain sectors and certain kinds of customers.
You know, America's interesting. We are, by most measures, overbanked. Yet we've seen two phenomena happen at once. A shrinking of the number of investment and commercial banks in this country, and an expansion of unregulated non-bank lenders. But as one pool shrinks and another pool expands, the net result for the 240,000 businesses with revenue of $10 million up to $1 billion is that they actually have fewer choices in today's ecosystem, mainly because non-bank lenders tend to prefer large borrowers. So they like to go as high up the EBITDA scale as possible. And regulated banks often look the same. So the focus and the availability of credit for smaller borrowers is really bad in this environment. They've been disadvantaged post the great financial crisis, when obviously we had historic intervention by the Fed and the regulators.
Let's assume that those decisions were made on some kind of rational basis, for some kind of calculation of the risks and that sort of thing, and the transaction costs and the ticket sizes. So how do you overcome the things that have kept other folks out of that market?
The numbers are really favorable. I mean, first things first, you have 50 million workers employed by 240,000 companies. So it is a large addressable market with trillions of dollars of demand for capital in the form of debt and equity. So there are a lot of these businesses around. They tend to not be on the coasts. They are usually employing hundreds, sometimes thousands of workers. They 90% of the time are owned by families, founders, and entrepreneurs. Private equity really only has about 10% market share in this ecosystem of 240,000 companies. And so, in our experience, you need to be local. You need to have personal relationships, but you need to actually have domain expertise in the industries that we're talking about: tech, telecom, healthcare, franchising, transportation, logistics, business services. And you need to come with something of value beyond just money. And this explains why we are so focused on worker benefits and seeing that we have less turnover, greater healthcare benefit adoption, and greater retirement benefit adoption, because those things are priorities for business owners who are struggling to keep workers in their seats in this inflationary economy. Wages are not enough to motivate workers in America today. They're looking for the total package, and that includes job training, an appropriate healthcare plan, an appropriate retirement benefit plan, particularly for the lower wage workers. And we bring that expertise and resources in that way to our investing strategy.
I'm very interested in that because I know that it's sort of integral part of the whole proposition. I think you have a unit called Worker Solutions that helps companies make some of those kind of changes. How does that work?
Worker Solutions is a unit within Lafayette Square with a full-time professional staff focused on partnering with management teams to reduce turnover and increase adoption of healthcare and retirement benefits. We are experts at understanding best-in-class service providers that can help in these areas. We actually negotiate discounts with vendors in that space and make introductions to our portfolio companies. And to the extent our portfolio companies adopt services, we actually will give them an interest rate reduction, a step down, as an economic incentive. What we know from experience is companies with lower turnover, higher productivity, workers who are healthier and enrolled in retirement, those companies repay their debt faster. So we like reducing the probability of default in our portfolio by focusing deeply on geography and this worker benefit opportunity, which is encapsulated in our franchise Worker Solutions.
So you're saying that the borrowers actually get lower interest rate for adopting the kinds of policies that will also help them retain and motivate their employees? That sounds pretty good.
Yes, because it is risk reducing, it makes sense that we would provide an economic reward for something that gives us a better chance of getting our money back.
Now, I saw in the 10K that you file that you also have a line of credit that gives you some incentives to offer these kinds of services down the line to the borrower. So the risk reduction, I guess, goes up even a level, one more level up.
The capital markets and federal regulators have provided multiple incentives to the private sector to align their investing strategy with public policy. We chose the name Lafayette Square not just because I'm a native Washingtonian, but because Lafayette Square is a park across the street from the White House and Treasury. So we believe deeply in aligning public markets and private markets to advance this agenda of employing working class people, uh, driving capital to working class places, and seeing that workers get every opportunity to lower their turnover and increase adoption of benefits. All of this has been codified in multiple legislation put forward by multiple administrations. And I think the private sector is coming around to see the opportunity embedded in the existing legislation.
That is kind of interesting. I know that you're keen on things like the small business investment companies and so-called SBICs and business development companies and CRA. A lot of things, as you say, that have been encoded in policy. A lot of folks who chafe at regulation. You seem to think that maybe it actually confers some benefits.
Yeah, one of the things I learned at Goldman Sachs, I remember this vividly as an analyst around the time of the IPO. We had a communication from our then CEO, a guy called Hank Paulson, who was a very elegant man. He said to the firm, he said, it's so interesting the way he framed it. He said, at Goldman Sachs, when we're serving our clients, we run toward a fire, not away. And granted, I'm 48 years old. I heard that when I was 23 years old, so it's been some time. But it really stuck with me, the values and the intention of being a great service provider in that business. Which brings us to the question at hand. We believe you should run toward Washington, not away from Washington. We believe you should run toward public policy, not away from public policy. We believe you should run toward regulation, not away, particularly when talking about extending credit to small, medium-sized businesses where you are enjoying regulatory inducement, regulatory advantages. That largesse should not be monetized by the private sector without some sense of responsibility, some sense of purpose, some sense of place in the broader capitalist system.
So I think you, if I read the report right, went from something like 4 or 5 investments a couple of years ago and put in place another more than a dozen last year. I think you're up to maybe 19 total investments, and I think $270 million in capital deployed. What kind of businesses are we talking about?
Well, we have a platform with multiple investing pockets, including separately managed accounts. Across our platform, we track and measure not only our deployment into the number of companies, but we're tracking and measuring the number of workers employed by those companies and how many workers are adopting services provided by Lafayette Square. Our goal is to see, along with a healthy return for our investors, at least 100,000 workers employed by our various portfolio companies. And we want to see 50% of our portfolio companies adopt services. Our goal is to get to a healthy, diverse number of portfolio companies as quickly as possible. So the goal that we talk about a lot around here is when and how we get to 100 investments or more, because I think that number, ironically, even in the context of 240,000 companies in our addressable market, I think 100 is a pretty robust figure, given what we do in middle market credit.
And again, just the kinds of companies are bread and butter, middle market companies with dozens, hundreds, even a couple thousand employees, right?
Yes, I mean, look, this is normal stuff. These companies employ 50 million Americans. That's 50 million out of a labor pool of 150 million. So if you take away government jobs, you take away large public companies, what you mainly have left in America is middle market employers who do everything from make hamburgers at your local quick serve restaurant to provide software or trucking, uh, even taking care of your pet, whether or not you're taking a trip and need to leave your dog in a spa environment, or if you're walking through an airport and want to make sure that the TSA folks have properly trained dogs to search for munitions. This is the backbone of the American economy. This is the heartbeat of our society. This is 50 million companies who are, by and large, not receiving the access to capital or the level of service they need. And so this is why we're so obsessed with reducing turnover and boosting benefits. If we get it right with these 50 million companies, it really does propel the entire society forward.
Now, one thing I did notice was that if you, and you do track, and it's very impressive, the sort of data metrics that you track across all the companies. And one of them, as you say, is the adoption of these kinds of services, healthcare benefits and retirement benefits and other kinds of things. I noticed that some of the metrics of the portfolio companies are below average. I'm wondering whether that's an opportunity for improvement, or what do you make of those kinds of figures?
It's interesting. We're professional investors, and we invite scrutiny. But the first and most important thing of all is transparency. We have to have an environment in which, warts and all, there is transparency, not glossy PowerPoint presentations, but just facts. And the data needs to be measured and assessed over time. There's a longitudinal mindset that one has to have, particularly when you're in the investing business, making, in our case, 5-year loans normally. So quarter to quarter, year to year, the data will be what it will be. But the promise you have from Lafayette Square, the covenant, is transparency, and that we're going to collect as much as we possibly can and lay it out in digestible format, because we think the ecosystem deserves it. We think it's a way to hold ourselves accountable. And as I said at the top of the podcast, the most important thing we've done as a firm is commit publicly to 2030 goals.
Interesting, interesting. Yeah, the data that you collect and analyze is impressive. I think you've got an overlay of all the census tracts and by income, by education, by assets. How does that help you?
Well, investors deserve it. And if you live in the context of 2030 goals, with this commitment to bring managerial assistance to portfolio companies, we believe it sets you on a path to be in the technology business, where you have to use robust analytics to track and measure all of it. Particularly when you start talking about geography, when you start talking about workers and their wages and their adoption of healthcare benefits, it leads to myriad opportunities to apply almost three-dimensional context to the good and the bad that's happening in these businesses, which is a predicate to then coming with rational solutions to affect change. Worker solutions, as we call our managerial assistance business, heavily relies not only upon our capital, but really it heavily relies upon our data analytics. We call that business Potomac.
You've been at this now. I think it was almost a pandemic era idea. So you've been at this now about 3 or 4 years. What surprised you the most, and what's what's been confirmed in your initial thesis?
Well, I'm surprised that more people haven't figured out just how important geography is in our system, or the data regarding the actual plight of working class people in America. Um, it's news to most people that low moderate income workers, meaning the bottom 80% of area median income in any zip code in this country, adopt company offered health care only 20 or 25% of the time. Adopt company offered retirement less than 30% of the time. That's a surprise to most people, because we don't think about our labor pool stratified by wages, and we don't think about geography as being a critical driver of outcomes for business, both in terms of the availability of capital and the cost of capital. So I would say it surprises me, but it also invigorates and energizes me that that data is available, and we can share that news and demonstrate how to make money off of that information, because most people just don't see it. They don't think about it in their day-to-day lives. The team and the culture we have at our firm is easily number one, the most exciting and rewarding aspect of this journey. We have a phenomenal team, 55 colleagues who are aligned and motivated and super energetic about bringing thoughtfulness and innovation to this work, with that level of transparency and accountability we talk about, all rooted in our 2030 goals.
So just take it up a level. There's a lot of discontent out there, the hollowing out of companies, of jobs, of communities. People aren't getting healthcare benefits or retirement benefits. They don't feel secure in their situation. It leads to all kinds of bad effects in society. What do you think let's say a few years from now, you guys are growing, and other folks maybe are seeing the opportunity? Where does this all go if it all works?
If it all works, we will make profits, which inherently draw attention and cause other institutions to adopt an investment strategy that contemplates geography and employee benefits. I think it is unavoidable in our system. It's always going to be about money. And if you're making money and providing data, and people believe your strategy is replicable, it will attract attention. And in the end, success is creating a bull market for supporting working class people and working class places. Wouldn't it be amazing if we had competitive dynamics and competitive juices flowing to the point there was a food fight to get capital into working class places and to businesses that employ working class places? That would be success. It's not just making a buck. It's creating conditions for many different investors to change the way they go about their work and to bring more capital and attention to this phenomenal opportunity set where we are betting on America. This is a pro-America agenda. And we need as many people with money and power and resources to adopt this approach and get capital into these places and to these people.
Well, that's a perfect place to leave it. Damien Dwin, Lafayette Square. It's a pleasure to talk with you, and we're going to be checking back often, and hope you'll come back.
Thank you for the opportunity. I'm looking forward.
Thanks to all our listeners and to our producer, Isaac Silk. We look forward to bringing you more conversations with agents of impact. You can see all of the shows in the Impact Alpha podcasting network at impactalpha.com. And make sure to subscribe wherever you get your podcasts. Till next time, I'm David Bank.